Monetary Operations Explained. Today we are going to go through T-charts of how money is created and how the financial system works. We recently did an episode in which we explored how the Treasury creates money. But today we are going to lay out for you T-chart after T-chart and explain how money is created from banks, the Fed, Repo, QE, and much, much more. Welcome back to the Bitcoin Layer. I'm Nick Bhatia. Today we welcome back Ritik Goyal. We are going to go through a dozen or more monetary operations and show you with a very detailed slideshow each T-chart operation and explain how money comes to be. We are also going to debate, Ritik and I, the semantics around these issues. Is QE money printing? Is Treasury issuance money printing? Is repo lending money printing? We are going to discuss that, as well as potentially, are these things inflationary and do they drive asset prices? So Ritik, welcome back to the show.
Thanks for having me.
Okay, so you put together an incredible slide deck for us because last time people were left asking for the T-charts themselves. So Ritik put in a lot of work here, and I'll hand it over to you.
Great. So I'm excited to walk through some of these operations, and like you said, hopefully help us answer some questions about like what really is money and how does money come into existence. So the things that I think basically cover all of our bases are lending, asset purchases. So like when the Fed is buying an asset, when a bank is, when a primary dealer is, when a non-bank is, and when all of these different entities are buying from each other, what does that look like? Because depending on where the entity is on sort of the layers of money, it can actually look kind of different. Then also what happens when the Treasury spends money? What does sort of liquidity mean? How does the Fed interact with liquidity? And then what does debt monetization mean? And what does that look like? So those are the things that I wanted to hit. And I think once we lay those out, like you said, we can get into some of the applications of this, including, what is money printing, what counts as it, what doesn't, and some of those questions.
And the important thing to note here is that both Ritik and I are students and practitioners. So we're practicing this, we're writing about it, we're studying it, and we're trying to learn more about it. And there are so many financial experts, veterans, portfolio managers, economists, traders out there that are doing work on this topic itself. We are not here to say that we are the authoritative voice on what to classify each of these things. But what we do know is that the language that we share is accounting. And the accounting itself doesn't lie. So that's where we're going to start today.
Yeah, exactly. Cool. So the approach that I kind of wanted to start off with is what I deem like a modular approach, which essentially means that if you wanted to expand out, the universe of all the entities that are participating in these various financial transactions, you can get a very complex view of what the sort of financial system looks like. And then that can be simplified down into, fewer and fewer parts without really losing any accuracy. So that's what I think the great thing is. So at the top, we could start with the system that's the government, so the Fed, the TGA, the Treasury General Account, and then various non-bank entities like primary dealers, money market funds, and households. And each of these entities can have their own bank. So we can end up with a very simple transaction like QE involving over 8 different balance sheets. But if we start consolidating these into more sort of simple parts, so we can take the banks, the primary dealers, the money market funds, consolidate that into the financial sector. We can consolidate the Fed and the TGA into just the government. And when we represent these various transactions with a more consolidated approach, I think there's a lot of valuable insights to that approach as well. And I think walking through some of these operations at the expanded level and then also at a consolidated level, even as consolidated as just 2 balance sheets, the government and the private sector, I think there's a lot of pretty interesting insights from that. So I think if this makes sense, I think it's kind of a good way to look at it.
And that's an excellent place to start the nuance discussion, which is that in the expanded approach, we of course have the Fed's balance sheet and the Treasury Department's balance sheet as separate entities. But in the consolidated version, Ritik combines them into the government into one entity. And one can argue that the Fed and the Treasury are one entity that are working as two balance sheets, but are working together on policy and on outcomes. And one can also argue that no, that it's not the case. The Fed is independent from the Treasury Department. The decision-making process is separate. And so we don't even have to debate that right now. But just to explain at the beginning how much nuance there is here, even we can even debate whether consolidating those two entities into one government balance sheet is a legitimate approach. But for the sake of what we're doing here, we're going to look at the way that you've laid it out, both expanded and consolidated.
Yep, exactly. Cool. So let's get to it. So, and then, yeah, and the other part of this modular approach is basically that something as simple as, a bank buying a security from a primary dealer, that thing can be consolidated so that you can basically abstract that away and then focus on another piece. So you can kind of, play with these pieces and add or remove complexity.
The Bitcoin Layer is sponsored by River. Make sure to check out river.com today or the link below in the description. River is our preferred place to purchase Bitcoin. Now, when you're buying Bitcoin, guys, there are several considerations. Number one, should I be using an exchange? Is the exchange custodying their own Bitcoin? Is the exchange using platforms to custody that we don't know? Is the exchange leveraging its Bitcoin for other purposes? Well, with River, we know that River does not use leverage of any kind. River also uses its own multi-sig solution so that your Bitcoin are not held by anybody else. So it's a very important thing to understand about what River offers. Now, River also has Lightning Network integration and a lot of other really exciting features. Go check out river.com today.
I think the first thing that we'll start with is bank lending. So this is, I think the most classic form of like money creation, which is essentially a bank hands out a loan by crediting a depositor with a deposit account. So that's what this looks like, which is, you have a commercial bank A and a non-bank, like a household that banks at that bank. And the way that money comes into existence in this case is the non-bank desires a loan. The commercial bank is willing to give that loan to that non-bank. And all that happens is it's a balance sheet expansion for both parties. So both parties are left with an additional asset and a liability. And the non-bank's asset, the deposit, is the commercial bank's liability, and the commercial bank's asset, which is this loan to this non-bank, is the non-bank's liability. And so here money has clearly been created. The deposits have the ability to be spent in the real economy or on financial assets. But I think it's interesting that no new net worth has been created here because assets and liabilities have been created at the same time. So no player is particularly richer. But that's how a loan sort of comes into existence, and then how money comes into existence. And what I think is interesting here is that banks themselves hold tons of, you can call it deposits or you can call it cash, deposits at the Fed. So, commercial banks bank at the Fed. But that cash, or you can call it reserves, those reserves were never really a part of this transaction. What drove this transaction was that, the commercial bank decided it's a good idea to hand a loan to this non-bank, and then they expanded the balance sheets. The second part is if there is a sort of reserve requirement in which a bank is required to hold, a fraction of their deposits as reserves. So, if this commercial bank has $1 billion in deposits, and there's a reserve requirement saying that, 10%, you must have it in reserves, 10% of your total deposits, then it could be so that when the commercial bank creates this new loan, that now they're over their reserve requirement. They have too many deposits relative to their reserves. So the next thing that the commercial bank would have to do is acquire these reserves by grabbing them from another commercial bank that's willing to lend them out. And the way that this transaction would work is simply the commercial bank that's in need of reserves would find them from another commercial bank who's willing to lend them and create a Fed funds loan. So this is a sort of unsecured loan where the two commercial banks agree that they'll exchange reserves for a night or for a week or some short period of time. And that's how commercial bank A in this case would acquire the necessary reserves. But I think it's important to note that that happens sort of after the loan is created. The reserves aren't as much of a constraint on lending. It's more there's a regulation in place, there's a requirement to hold reserves. The commercial bank will meet that requirement if at the end of the day, the commercial bank has too few reserves. But the main thing that drives the money creation here from the perspective of a non-bank is the creation of new money through a loan.
Okay, so one thing to note on the reserve front, what Ritik is saying about the banks create money first and then they worry about reserves second, that is not only applicable to what we're talking about, but it should be also explained with the fact that today the reserve requirement in terms of the ratio mandated by the Fed on commercial banks in the United States today is 0%. It means that the technical quantity of reserves at each commercial bank is not the constraint on the bank creating loans. The bank's constraint on creating loans is, of course, its own risk management, whether it's a good loan to make, but then it has to adhere to other liability framework regulations and other asset side regulatory considerations, but none of those are explicit reserve requirements. So that's the first thing that we should say. That's why these two things are especially not related.
Right.
They're related, but they're not linked. They're not explicitly linked. But then, Ritik, if you can please now take the commercial banks, the second line off of the screen. Let's go back to just the bank creating money. Now, I want to just summarize for people what Ritik is saying, and I have a slide extremely similar to this in my USC class. I teach it twice during the semester in a different way. This concept is the fundamental concept of credit money, the theory of credit money, which is that a bank lends money into existence by creating a deposit for you. You are the household. You now have a checking account deposit and you owe money to the bank in a year's time, if that was the term of the loan. The reason that the bank is able to create a loan as its own asset comes back to Finance 101, which is that the loan is a future cash flow to the bank. So because you owe the bank money, the bank will get money in the future. Because the bank will get money in the future, the loan is an asset to the bank. And that is the fundamental thing to understand here about why this is money creation. And then I will summarize for everyone something that I'm putting in my second book to explain how money works and just the concept of it, which is that it takes only one bank to create money, which is the example you have here, but it takes two banks to circulate it, which is that another bank accepts the household's deposit when that household spends. And who decides that the second bank approved the first bank's deposit as money and accepted that transfer? That is banking charters. That is the club of banks, and that is how money works. So that's the setup, and I think now we can continue on with our deck.
Cool. Great. Yeah. So that's, I agree. That's basically the most foundational sort of credit money operation in the economy. But there's all sorts of other types of lending, including repo lending. So now we basically break into a system with more than one bank and then also more than one non-bank. So here, non-bank A banks at bank A, and then non-bank B banks at bank B. And so what repo lending is, it's really not much different than a bank loan, but it's essentially a short-term loan that tends to be collateralized by some sort of very safe asset that has no or almost no risk of default, which allows banks or any party that's borrowing in the repo market to access funding for a short period of time, that's collateralized by like a treasury, for example. So here there's all sorts of repo loans that can happen. The bank can make a repo loan to a non-bank, a bank can make a repo loan to a bank, a non-bank can make a repo loan to a bank, and then two non-banks can make a repo loan to each other. So we can walk through sort of what each of those looks like. So the first one is that a non-bank here lends to another non-bank. So again, because what we as the non-bank household sector see as money is actually bank liabilities, it's bank deposits. The actual changing of who has the deposit has to occur on the bank side. So that's why banks A and B here are relevant and are part of the picture, even though it's non-bank A and non-bank B that are doing the transaction together. So if we forget the banks for a second, it's pretty similar to a regular bank loan, which is that non-bank A is making a short-term loan to non-bank B. So the deposits that non-bank A has, the money gets sent over to non-bank B, and now non-bank B owes that repo loan to non-bank A in a short period of time. And when I say non-banks here, it's not as much like households making these loans. It's more like money market funds or primary dealers or sort of other financial players.
And let me just
Yeah.
interrupt you here. In this specific example, the non-bank A is the money market fund in theory here, and the non-bank B is the primary dealer. So you can even go, because it is the non-bank A, the money market fund here, that starts with the deposits. Whose deposits are there? They're the people's deposits, right? The people have savings. That is the cash. So the money market fund is non-bank A. The money market fund has deposits, so it has cash. It decides to invest in repo, and that's why you have minus deposits and plus repo, because now the money market fund owns repo and doesn't have the cash anymore. The cash is now a repo loan to a primary dealer, and that's the non-bank B. So now the primary dealer gets cash. That's what the dealer needed. The dealer needed cash. Now it has cash from the money market fund, and it owes money back to the money market fund tomorrow. And so continue on.
Yeah, right. So if non-bank A here is a money market fund, then the reason why they would want to engage in this transaction is because these deposits are, unsecured bank liabilities. You're basically exposing yourself to, the counterparty risk of the bank. So it's advantageous for you to instead basically receive the repo rate as you invest these deposits rather than just holding the deposits. And then on sort of the back end, the banks have to clear this transaction themselves because, like we said, the deposits are their own bank liabilities. And the way that this occurs is that one party now here, in this case, non-bank B, has more deposits. So bank A has to sort of transfer the necessary reserves on the back end to clear that transaction to the new bank that now owes those deposits to whoever's holding those deposits. So here that simply looks like Bank A gets rid of its reserve assets, and now it no longer has a deposit liability to non-Bank A, and those reserves end up on Bank B's balance sheet. And so here, the balance sheet's all balanced. So now that's not two non-banks repo lending to each other. So the next one is what happens when a non-bank lends in repo to a bank. So now, non-banks on their asset side, money for non-banks is deposits, but money for banks is reserves, and liabilities for banks are deposits. So this actually looks a little bit different, which is that non-bank A here is banking with bank A and creates a repo loan, essentially gets rid of its deposits, so it changes its deposits to repo, and bank A transfers those reserves to bank B, who is the borrower. So in this case, if bank B, needs short-term liquidity, it needs reserves to satisfy any sort of requirement, regulation that's in place, the bank can essentially access that funding from a non-bank, in this case, a money market fund or any other non-bank player.
Okay, now I want to just really quickly
Yep.
mention in both the non-bank A examples, you have plus repo and minus deposits on the asset. The reason why the non-bank or the money market fund here does this, as Ritik was saying, is that you want to get rid of unsecured money, which is the deposit. You don't want the unsecured money. You want secured money. And that's what repo is. It's secured money because it's collateralized by a treasury security, for example. So when I tell people that I start my day with what is the repo rate, what am I asking the market? I'm asking the market, what was the price of secured money yesterday for banks and for the banking system? Because it's not even technically just for banks. It's whoever has treasuries, whoever needs cash and has treasuries, whoever uh, has cash and is willing to accept treasuries to secure the money instrument that they're going to hold overnight. So that's why it's minus deposits plus repo, because it's minus unsecured money and plus secured money. So we start our day at the Bitcoin layer with what is the SOFR rate, meaning what is the average price of money using treasury securities as collateral from yesterday in the financial system. That tells us what is happening in the money market. So when we think about money markets, what is money markets? You can start right here at the price of money when you're trading from unsecured to secured money. And that is why LIBOR has gone away and why we have SOFR now, because SOFR is basically an average repo rate from yesterday. And this is SOFR, what we're looking at here.
Cool. Great. So this is what it looks like when the non-bank is the repo lender, and then also banks themselves can be repo lenders. So that's here. The third row is what it looks like for a bank to make a repo loan to a non-bank, and then the last one is a bank making a repo loan to another bank. So on the third row, when a bank makes a repo loan to a non-bank, the same sort of process occurs where a non the entity who's making the loan gets rid of their cash, but like we said, banks don't hold or they don't own bank deposits. They own Fed deposits, which are bank reserves. And what happens then is the problem is that the non-bank, in this case, the borrower, owns or holds on its asset side bank deposits. So the bank that's making the loan, Bank A, needs to sort of interact or transact with the bank that the non-bank, in this case, Bank B, transacts with. So the way that looks is, again, Bank A gives up its reserves, now takes down a repo asset, hands those reserves to Bank B, who then credits non-Bank B's asset side with those deposits because it's non-Bank B that's in need of cash, and now non-Bank B owes to Bank A that repo asset. And then in the case of two banks lending to each other, now the entire system occurs with just reserves to clear this transaction on the back end, because there's no real bank deposits that are at play, because there's no non-banks that are in this transaction. And so here it's pretty simple. It's simply the lender bank, Bank A, hands reserves over to Bank B, and Bank B owes back to Bank A repo loan. And I should also note that like the handing over of reserves, it's basically just computer accounting entries that are just incremented up or down depending on what's going on.
Okay, a couple things here to note. One thing missing from the balance sheets, but it's theoretical, which is that each bank that is borrowing money in the repo market must also own treasuries on their balance sheet. So there's a hidden treasury line item that doesn't change because when you pledge the asset, you're still the economic owner of the asset. So it doesn't leave the asset side of your balance sheet. You pledge it, and then you have that accounting entry as its own repo asset and liability pair. So that's one thing to note here, is that for any bank that's borrowing money in the repo market, they must also own the treasury. So those treasuries are hidden on these bank balance sheets. And then the important note, and this is something that I think it's so important to drive home. Reserves themselves are the bank's money at the Fed, and reserves are only required when banks settle transactions between themselves. And that we will see even more how that plays out when we get to the slides on the Treasury general account and how money actually moves into the Treasury's checking account. It can only come from a reserve balance or another Fed liability from the accounting side. So I'll pass it back to you.
Great. Yeah, the first point you made is definitely key, which is if we just take this bottom example, Bank B here is borrowing. Bank B needed to already have a treasury security on its asset side, so that when this transaction is going on and it's essentially it's taking place, that treasury is now sort of like in possession by both parties, kind of where if Bank B suddenly failed while this transaction is going on, then now Bank A would take possession of that treasury security. But if the transaction goes down and then it gets closed a day later or a week later, then the treasury has never moved hands because it was never needed to be applied as collateral. So that's a great point.
And even one more nuance here, because I might have even simplified it too much. Repo, the full word of repo is repurchase. So even though you have economic rights over that asset, it's because you've actually sold it with the right to repurchase it. And that's why technically Ritik is saying that it does leave your balance sheet. The Treasury actually, because you sell it and repurchase it, and then the construct becomes a collateralized loan. And we're not going to get into that today, but that goes back to court cases from the 1970s and 80s when the judicial system was essentially determining what repo was. Was it money? Was it a loan? Was it a sale and a repurchase? And I know Ritik is very familiar with Jeff Snyder's work, and that's how he came across a lot of monetary mechanics and the curiosity itself. He and I had that in common. So there's a whole backdrop to that, and we would recommend, Snyder's work, of course, in terms of understanding the history of some of these monetary instruments and how they came. But my point here is that repo, the full word, is repurchase.
Great. Awesome. So the next sort of set of operations that I think we can build off of the basic, bank loans and repo is what happens. What does it look like for the Fed to be a lender? So again, we have our sort of layers of players. We have the non-banks that never interact with bank reserves. They own bank liabilities like deposits, and then we have the banking system, which owns reserves, which are Fed liabilities, and they owe deposits. And then we have the Fed, and the Fed, we like to say is supposed to be the lender of last resort, meaning when nobody else is willing to, it supplies liquidity to the banking system in case of a bank run or a panic where depositors want to withdraw their money. And so there's a few ways that this can actually happen, where the Fed provides reserves to the banking system when it's in need. So there's the traditional one, which is the discount window. Then more recently, since the March 2023 sort of banking crisis, you can call, the Fed implemented the Bank Term Funding Program. That's another way that the Fed can supply liquidity. And then the Fed can also provide repo loans to the primary dealers. And this will become especially relevant when we walk through how primary dealers buy treasuries at auction. So we walk through these. It's very similar to the way that a bank would make a loan to a non-bank, which is that the lender and the borrower both simultaneously expand their balance sheet. So no new net worth is created again, but reserves have been created and handed to the commercial bank. And in exchange, the bank now owes a discount window loan to the Fed. So it's the exact same really as a bank and a non-bank loan creation. It's just that here it's the Fed that's creating reserves and handing them to the commercial bank. And the reason why the commercial bank would engage in this is if they're unable to borrow the reserves from other parties. And typically, if that's the case, then there must be some sort of, trust issues with this bank. And the fact that they're going to the discount window is not very good for their, credibility to depositors either. So whenever this type of transaction is happening, that typically means that that bank is close to, if not basically already failing. So then the similar thing happened. A similar process takes place with the BTFP program, which is it's the exact same thing that happens, which is a bank needs liquidity, it receives the reserves from the Fed, and instead of just calling it a discount window loan, now it's this other facilities loan. It's the BTFP's loan. And what's a little bit different about the BTFP is what happened with the March 2023 debacle is essentially that a lot of these securities that banks had bought at very low interest rates are now deeply underwater because interest rates have risen. So the really unique thing about the BTFP was that the Fed was providing reserves essentially at par against that collateral. So if a commercial bank has a treasury that's only worth 80 cents on the dollar, the commercial bank could pledge that to the Fed and receive still $100 worth of reserves. So I think there's a decent argument to make that the BTFP program is actually much more akin to sort of money printing or revaluing assets, and that's why I think it was actually pretty effective at stemming the banking crisis. But in terms of the balance sheet operations, it's the exact same as a discount window loan. It's just that here there is a collateralized portion where banks can borrow through that mechanism. And then lastly is as a Fed repo loan to a primary dealer. So again, here a primary dealer isn't a bank; it's more of a non-bank. So the primary dealer has to work through the commercial banking system in order to make the transaction settled. Because again, the Fed's liabilities are exclusively reserves, and reserves can never reach the non-bank sector. So here, what it would look like is the primary dealer wants a repo loan. They want deposits to be able to buy a security or engage in some sort of other financial asset purchase. They'll get the repo loan. The Fed has the ability to be that repo lender through things like the standing repo facility, I believe. And the way that this would work is the Fed would accept that loan, create the reserves out of nothing, credit the commercial bank with those reserves, and the commercial bank would credit its depositor, the primary dealer, with those deposits. So that's how this would look. And again, since it's a repo loan, it would be collateralized by a safe asset like a treasury.
Now, this is the perfect opportunity to have our first discussion over whether the Fed prints money or is creating money when it creates reserves. So each one of these balance sheet and operations is an example of reserve creation out of thin air. That is not debatable. That we agree on. I think what the semantics that the whole world obsesses over is whether this operation can be called money printing, and even adding one more layer, whether the operation causes inflation and or asset price inflation. So those are separate. So just give us your baseline take, Ritik. What is your answer to, is this money printing to you or not? Yes or no? And is it a driver of inflation? Yes or no? Is it a driver of asset price inflation?
Right. So I think the way I would sort of frame this is there's the type of money printing that occurs that doesn't create any new net worth, meaning that if both parties, if the borrower is adding to his assets, but it's also adding to its liabilities, then it's not becoming any richer. But it's still the case that new like monetary resources have been created to then fund an asset purchase. So in that case, it absolutely can be inflationary, especially for assets. And I would consider this money printing when new reserves are created and handed to the commercial banking system that can then do things with those those reserves. But like I just mentioned earlier, the case with the BTFP, I think is absolutely money printing, and it's even more so because the Fed is literally handing commercial banks more than what their assets are worth. So if something is worth 80 cents on the dollar and now it's being valued essentially at a dollar, you can get a dollar's worth of reserves in exchange for it. Then that's the truest definition of money printing, because the bank is really becoming richer in that sense. And that's why I think the crisis was stemmed very rapidly. So I would consider this money printing, but not in a CPI inflation sense, more in an asset inflation sense, because the deposits, the reserves that are created through these transactions almost exclusively go towards spending on or purchasing financial assets. They don't go towards purchasing goods and services, because that spending tends to happen with the non-bank household business sector. And this type of lending doesn't really concern those.
And that's a great point. And the the impetus for the CPI portion of this inflationary dynamic has to come from one more balance sheet operation, which is that the commercial bank then now it has more reserves, and so it feels more confident to make the loan to the household. And then the household has deposits, and even though it has a loan on the other side, meaning it owes money back, it can spend those deposits and money can achieve velocity, and that money velocity can raise aggregate demand and then cause the price level to go up. So I want people to understand how many more balance sheet operations must happen for this to be inflationary. But you make an excellent point, which is that the financial assets themselves are the primary beneficiary, and that is why the Fed and other central bank balance sheets expansion has been correlated with asset price inflation, including stock prices. Yeah.
Right. Great. So now I think the first application of all these, so those are basically like the pieces that I think are necessary to then get to any other transaction. So the first thing is quantitative easing, or QE, in which the Fed purchases assets from the private sector and creates reserves out of thin air. So mechanically, the way this works is the Fed actually only has the ability to transact with the primary dealers. The Fed can't go directly to a household that owns a treasury bond and buy it and hand it a bank deposit in return. It actually happens a little bit more indirectly. So this kind of spells out the ways that the treasuries get to the Fed. So, you can start with a non-bank or a bank owning a treasury. The non-bank or the bank would have to sell the treasury to the primary dealer first. The primary dealer will have to buy it, and then the Fed can buy it off the primary dealer. And then also, when a non-bank sells an asset, it's not trying to sell it to a particular party, just selling it into the open market, and the bank can be a buyer of that. So we can walk through, and we will walk through what each of these operations look like what does it look like for non-bank to sell to a bank or to a primary dealer. And then you can build those through this sort of modular approach as to what QE would look like, depending on who the ultimate seller is, whether it's a non-bank or a bank.
And I should have told people at the beginning, but I hope you guys have your pens and pencils and your notepads out, because working on these, if you really want to understand, you have to do the T charts yourselves, and you'll have to go back and pause and rewatch this episode so that you can do the full learning. There's just no way to fully verse yourself in all of what Ritik is teaching you today without practicing it with the T charts yourself. So I would strongly recommend people to get their notepads out and practice so that you understand what we're talking about.
Yeah, cool. So if we break down all those transactions, basically the Fed is the ultimate buyer, and then any party can be the ultimate seller of these treasuries in this QE transaction. So we have, the primary dealer ultimately sells to the Fed. We have the bank sells to the primary dealer, or a non-bank can sell to the primary dealer. And then we can also have a non-bank selling to a bank, who would then sell to a primary dealer, who would then sell to the Fed. So each of these has its own, set of T accounts, and we can walk through them. And they are basically laying out how assets move between these layers of money.
Can I,
so the first one,
pause for a second?
Yep.
I want to, before we even get to all of this, we're talking about how treasuries get to the Fed, but then the question then becomes, and this is the question many people have, is the Fed monetizing the debt if they're buying treasuries? The semantics is that no, because they're not buying them from the government directly, they're buying them from the private sector. But then people say, well, that's just semantics, because now they're holding treasury debt, they're holding it to maturity, so they are a force in the market. So just give us a summary of how you feel about that before you walk us through how they get from the private sector to the Fed.
Sure. So Yeah, so like you said, especially if you look at what happened in March of 2020, the government spent a lot of money, and then the Fed was also buying a ton of assets, and now the Fed hasn't immediately sold all those assets. So it really looks like monetization, where the Fed is essentially handing the Treasury money, and so mechanically, like technically, based on what the current legal code is, you're right. There's no true monetization that can happen, but functionally a similar thing can happen. And so the point that I'll actually make is essentially that under the current structure of our law, the private sector is sort of forced to buy the treasuries at the treasury auctions, but the treasury also hands the private sector the necessary funds to do so. And so the way I would describe it is that treasury spending is essentially always monetized, meaning that the money always, when the treasury spends, it creates money and then it hands that money to the private sector who can then buy the assets. So I would describe the Fed's role as a little bit more sort of secondary or indirect. But we have a slide where we walk through what counts as monetization, what's not, and what we can consider monetization or not.
Excellent. And I think that what you just said, how you just described it, is probably the that is at the crux of the debate, or
Right.
at the and especially at the center of understanding what's going on, is when the Treasury spends money into existence, the Fed is, from that perspective, simply a financial plumbing assistant in the money getting out into the economy. But, and this is the big asterisk on that, and a big thing, a part of our belief at the Bitcoin layer, and my research suggests to me that because you have this assistant that is so willing and able to assist, it makes the money printing as much the fault of the Fed relative to any party, including the Treasury, and that can be debated and that can be discussed. But that is, I think, at the center of the understanding. And I think any sane person couldn't confirm or deny either one of those sides. They're actually both true at the same time. So I'll pass it back to you.
Yeah. No, the reason why, even though we're walking through what seems like objective T accounts, the reason why there's still room for, debate is because we don't have tons of good case studies of, a case of the Treasury trying to spend $10 trillion without the Fed doing any intervention. We don't have an example
Correct.
of like, would that actually work? Or on the other hand, the Treasury, the Fed purchasing all these assets, and the Treasury spending money. So until we have all of that history to make a scientific experimental conclusion, we really can't know what is and what isn't. We can just work on the mechanics in the meantime. So starting with the primary dealer selling a Treasury to the Fed, that's the last step in this QE process. Again, the primary dealer is not a bank, so it does not transact in reserves. It transacts in bank liabilities. The primary dealer had securities, treasuries, U.S. treasuries on its balance sheet. It sells those to the Fed, so the Fed now picks up those treasuries, credits the primary dealer's commercial bank with reserves because the Fed creates reserves out of nothing. The commercial bank then, with those reserves, credits the primary dealer, and the primary dealer is now left with deposits. So that's the final step of a primary dealer selling treasuries to the Fed. Then the second thing is the primary dealer had to essentially they had to get those treasuries from somewhere. So here, the reason why I've included a money market fund is because primary dealers typically don't. I mean, no large non-bank really has deposits just like sitting idly because of all the reasons we discussed. So a primary dealer will typically fund these treasury purchases in the repo market itself. And what this looks like is the primary dealer wants treasuries. It doesn't have any sort of idle deposits laying around, so it's not really giving up any deposits. Instead, the party that does have the deposits that wants to make a return on those deposits is a money market fund that has transaction all these different cash instruments. So the primary dealer takes possession of the U.S. treasuries from the commercial bank that's selling them, and now that commercial bank essentially relinquishes its deposits to the money market fund, and then the money market fund owns a repo asset instead. So the primary dealer has funded the purchase of the treasuries in the repo market. And I think there's some nuances about how, so like we said, the repo market is collateralized, and the primary dealer in this case can actually use the treasuries that it's purchasing as the collateral. But this is typically how that looks. And then the second one is if a non-bank sells to a primary dealer. So here we have the non-bank seller. You can say that's like a household who owns a treasury bond who now wants to sell it and buy something else. The non-bank seller gives up its treasuries. The primary dealer takes possession of those treasuries. But again, the primary dealer has to fund that purchase. And what that typically looks like is a money market fund providing that cash. And the reason I've included commercial banks here is because I'm here assuming essentially that the money market fund and the non-bank seller bank at the same commercial bank. And so if that wasn't the case and the money market fund and the non-bank had different banks, then on the back end, there would have to be that same transfer of reserves because one player is increasing their deposits and another player is giving up their deposits. But if we look at, and this is again the sort of idea of consolidation, if we take the commercial banking system as a whole, then all these players, bank at that commercial banking system, and there's no real transfer of reserves that has to happen. But I included the commercial bank just to make that point. And then lastly, the final sort of, maybe you can call the first step in treasuries getting from a non-bank to the Fed in this QE process is if a non-bank sells to a bank who then sells to a primary dealer who sells to the Fed. And that looks like the non-bank seller, like a household wanting deposits, getting rid of its treasuries. The commercial banking system would absorb those treasuries and credit the non-bank with a deposit. So this would actually be a case of the commercial bank levering up and funding those treasury purchases through the creation of deposits. So now, if we wanted to, we have all the players that are relevant. We have like the non-banks, the primary dealers, the funder of the primary dealer, the banks, the Fed. And if you wanted to stitch all of these together, we can do that. And I think the next slide is us doing that.
Okay, so there are a couple points, very important points that I want to make on this slide before we go on. The first one is in the second line and the third line, we have a money market fund that has plus repo and minus deposits. Now, I want to emphasize what has underpinned my framework, which is the inherent hierarchy of money. It went into the crafting of the layered money framework. Layered money simply means that we have a hierarchy of money. That means we have different money types, and we are seeing people and investors and households and banks trading between money types at all times. One of the things that Perry Merling teaches is that repo is how you live to fight another day in the financial sector. What he's specifically referring to is that the primary dealer itself that takes down the treasuries from the treasury auction that's when Ritik says that the private sector is forced to buy treasuries, legally forced, that's what he's referring to, is the primary dealer's legal obligation to take down the treasuries. You notice how the primary dealer has, in the second line, plus USTs and plus repo. That means the existence of treasuries, new treasuries in the market today, exists because at the first level, the primary dealer was able to finance the treasury at the same time with a repo loan. Where did the repo loan come from? The treasury might be a 30-year bond, but the repo loan is a one-night loan. And the one-night loan comes from the money market fund, which is, remember, our savings. And we decide to say, yes, we will take secured money for the night and give up the unsecured money. And in that way, it's called maturity transformation. You are transforming a one-night loan into a 30-year US government bond. And that is how the whole system lives to fight another day. Because if we look at spot SOFR volumes, they're about $2 trillion, which means the dealers every night are borrowing $2 trillion in overnight money using to fund $2 trillion of treasury securities in their inventory. That's the active inventory. Now we know there's 34 trillion, 35 trillion in total US Treasury debt. There are about 2 trillion in Treasury securities issued in a deficit on average for the last 5 years. So it's about 1 year's worth of deficit that is funded. The point here is that this is why repo is so important, because it's actually the maturity transformation between primary dealers and money market funds that makes the whole system tick. And it allows the system to get to the next day. Whether or not that is vulnerable to breakage or not is a separate debate. In September 2019, when we had a repo crisis, Ritik mentioned earlier the standing repo facility. That was a previous balance sheet operation. That is the Fed creating reserves and out of thin air and taking on treasury collateral from the financial sector. That is a reaction to the repo crisis of 2019. And that existence of the primary dealer inventory having to be rolled in the money market every single night through repo is at the absolute basics of understanding how our financial system works, how the dollar onshore system works. So go ahead.
Great. Yeah, that all is important stuff. And on the issue of the maturity transformation. So what I think is interesting here is right. So I think one question that gets brought up then is, what if the money market fund, or what if the private sector is out of deposits to transfer into these, or to convert into these repo loans? And so that's why I think treasury issuance and treasury spending is interesting, because on the other side of this is that when the treasury issues a treasury, it's also spending money into the economy at the same time. So somewhere in the financial system, there actually has been an increase in deposits that could theoretically go towards the financing of this treasury purchase. It's just, if it's a stimulus check that ends up in, some household's bank account that they're going to spend on groceries, like, is it really possible for that stimulus check to eventually get to the purchase of the treasuries? So that's when the question of, does the Fed have a role in smoothing the wheels of these treasury purchases? That's when those questions start to become very relevant. And I think we'll walk through those.
Yeah. So two more points then. On this topic of the treasuries coming into the system and then them having to be financed by either the deposit that was created by the treasury itself or from elsewhere, this now brings back into the conversation the concept of ample reserves or reserve scarcity at the Fed. Because at a certain point, you don't need reserves to create loans and create deposits, because the requirement is 0% legally. But you need reserves to get into the Treasury general account, and those reserves have to come from existing reserves. And as money moves throughout the banking system from the money market funds bank to the primary dealers bank, reserves are needed behind the scenes to get the treasury funded. And so that is why reserves matter, and that is why QT matters. We're not really talking a bunch about QT today, because QT is more of a maturity than a money operation. That's when money is created. But QT shrinks the quantity of reserves at the total Fed balance sheet level. And so at a certain point, you are going to run into reserve scarcity. Some people think it's imminent. Some people think it's $1 trillion away. Some people think because we have 400 billion in reverse repo that we have this, at least $400 billion buffer before we really have to worry about it. That's also not necessarily a conversation for today, but I want to bring different components in to teach people. The next point I will make is on the fourth line, which is an incredibly important point. It has been debated in recent podcast episodes. We've talked about it on our show. Ritik has written about this as well, which is that is when the Treasury just issues bills and commercial banks mop up these bills or basically take these bills onto their balance sheet, that straight printing money because they can just create deposits to do so?
Yeah.
The answer is a little bit yes, a little bit no. How would you respond to that and use your fourth line here to describe the nuance?
Yeah. So again, the question of, is it money printing? So the one thing we do know is that it's not net worth printing. So again, nobody is getting richer in this transaction. The non-bank had $100 in treasuries. Now they have $100 in deposits. So their purchasing power hasn't increased. But at the same time, more deposits are genuinely present in the system that can go towards financing financial asset purchases or spending in the economy. Most likely, somebody who's selling treasuries is not selling those treasuries in order to go buy something from a store. They're probably going to buy another financial asset. So I would consider this type of transaction money printing insofar as it increases the aggregate level of demand available for financial assets, and that can go towards asset price inflation. But as long as nobody has become richer, nobody's equity on their balance sheet has increased, I wouldn't consider it necessarily inflationary for CPI.
And the missing part of the fourth line item is the Treasury general account, which we haven't really talked about much yet. We're going to get into it. But when the plus UST happens at the commercial bank, that is when it buys it from the non-bank. But the debate on whether it's money creation is when the UST itself is created.
Right.
Where does that money come from? So we will get to that on a coming slide.
Great. So like I said, these are all the pieces for a non-bank to eventually get a treasury to the Fed. So this is an example of stitching those individual pieces of who's selling to who together, where a household sells its treasury ultimately to the Fed, but it has to work through this indirect process. So here, the first step is the primary dealer has to buy the treasury from some player, in this case, the non-bank household. So what it looks like is the household gives up its treasuries. It receives deposits in exchange. The primary dealer funds that treasury purchase through repo, through the deposits that it initially gets through the money market fund. And again, I've consolidated the commercial banking system. So if the money market fund and the household banked at different banks, then the household's bank would have to receive deposits from the money markets banks and money markets bank, and the reserves would have to be transferred on the back end. But if the commercial banking system is just seen as one, then the commercial bank is always owing a deposit to somebody. It was the money market fund and now it's the deposit. But the primary dealer has, in this step, taken hold of those treasuries and now is going to sell them to the Fed. So the next step then is, and now the household is not relevant, but the primary dealer here sells the treasury to the Fed. The Fed creates reserves out of nothing to buy the treasury, credits those reserves to the commercial bank, who then deposits the commercial bank sends those reserves to the money market fund, who then closes the repo transaction because now the primary dealer doesn't need that financing. So if we were to then stitch these two together, that would be the entire process. But that's what it looks like for a household to ultimately sell its treasuries to the Fed.
Excellent.
Great. So now I think is when I think there's value to sort of consolidating these different players, because these perspectives I think start to provide even more insight. So like we start with what I just had, which is basically everything laid out: the Fed, the entire commercial banking system, the primary dealers, money market funds, and households. We can sort of bring down the entire financial sector into just that one sector. Consolidating commercial banks, the primary dealers, and money market funds. And here, what it looks like for a household to sell a treasury to the Fed is the household gives up the treasury, the Fed buys it, credits the financial sector with the reserves to fund that treasury purchase, and then the financial sector, in this case a bank, creates deposits for the household. And so I think this perspective, it's a question of is this money printing? It is, in the sense of now households have more deposits that they can do things with, but it sort of isn't in the sense of nobody has increased their net worth in this transaction, so nobody's purchasing power has increased. And then we can consolidate the private sector, so here the financial sector and the household, into just one private sector. And here I think it's where it's clear that QE is truly just a simple asset swap. The private sector held treasuries and now they hold reserves, and the government, or the Fed in this case, is taking possession of those treasuries. And so all that's really happening here is, let's say the treasury that was bought was a 10-year treasury bond. The only thing that's really happened then is that the 10-year treasury bond has been converted into like a one-day treasury bond, or like an overnight, or a very short-term kind of cash asset. So all that's happening is that duration has been removed from the private sector, but also the income associated with that duration. So if we have a steep yield curve, which we typically do when the Fed is buying treasuries, prior to the QE transaction, the treasuries were yielding, let's say, like 2 or 3%. And now that the QE has happened, now the private sector instead has reserves that are yielding 0%. So all that's really happening is that risk is being removed from the private sector's hands and given to the Fed. And again, it's sort of debatable whether that constitutes money printing, and whether it's inflationary for the real economy.
Yeah, and again, a large part of this is semantics, because what we're looking at is a balance sheet tree, expanded balance sheets, consolidated balance sheets. We can, like we said at the beginning, I can argue that we shouldn't be consolidating the Fed and the TGA into the government balance sheet. So making Ritik's third line item here something that I would argue is an incomplete representation, but we're showing you the expanded version also. So that is, it's a lot of this is debatable on what you want to call it, and that's fine. But in this episode, our goal is to really just look at 100 different T-charts and give you the tools to take it into your notebook and theorize about what you want to call all of these things themselves too.
Great. So now flipping that sort of upside down, I've just a slide on QT, starting from the consolidated approach and then working down into a little bit more of an expanded approach, just to show how QT is literally the flip of QE, quantitative tightening. So here, like I showed in the last slide, QE was a simple asset swap. The private sector had treasuries, now it has reserves. In QT, it's the reverse. The government, in this case the Fed, gives up its holdings of treasuries, either by letting it mature or by outright selling it, extinguishes the reserves that the private sector no longer needs now that the private sector owns those treasuries. So that's the exact flip side of QE. And if we then expand the private sector here, it's again the reverse of the QE transaction, where the financial sector no longer has any need for the reserves, because instead of deposits, the household now owns treasuries. And those treasuries came from the government selling them and giving up those reserves. And then the last thing is, and here's where the TGA sort of shows up for the first time. If we expand the government into the Fed and the TGA, what I'm showing here is a case of what's called roll-off, which is the Fed not outright selling its treasuries, but rather letting the treasuries mature. And so when a treasury matures, you receive the entire principal of that bond back. And obviously, the government is in debt. It doesn't really have just funds available to do that. So what does it need to do in order to pay back the Fed who owns that treasury? It has to sell another treasury and receive the necessary cash. So what that looks like is the Treasury general account, the TGA, owed money to the Fed. The Fed owned this treasury. That treasury expires. The Fed says, where are my reserves? This treasury's matured. The TGA then issues another treasury. The banking system, somebody buys it. The household in this case buys it. The banking system hands the reserves to the TGA, and then the TGA hands those reserves to the Fed, and the Fed now extinguishes those reserves. So in this case, in this roll-off example, I would characterize QT, or I would characterize this process as kind of like a reserve drain, where QT is essentially extinguishing reserves that are in the system. And so the sort of monetary policy idea is that by getting us into more and more of a scarce reserves kind of regime, it's possible that that has tightening effects for the financial system.
And why does QT lead to a fall in reverse repo sometimes instead of reserves? It would be that last line on the household side. Instead of minus deposits, the household had cash and it replaced its cash with treasuries.
Yeah,
It's
yeah.
replaced.
We have a slide on this.
Oh, okay, perfect. So yeah, it's replacing the money market funds reverse repo holding
Right,
with
right.
treasury. So that's how RRP also plays into QT as well as reserves. So keep going.
It's great. So this is it. So like Nick was saying, in this example, it's possible that when that additional treasury issuance is happening to finance the fact that QT is happening, if there is this pot of reserves that are available, then those reserves can be the ones that get extinguished as they buy new securities, and in that way, it's arguable that liquidity for the private sector isn't really falling. So that's what we'll work through. So here, what I think is useful is on the issue of like Fed liquidity and the RRP, as a chart from a previous episode, showing all these different types of sort of cash assets, including reverse repo and reserves that are at the private banking system. So what's interesting here is basically in when the Fed began QT in 2022, the size of the Fed's balance sheet started to fall. So you would expect that to show up as, the number of reserves that the banks are holding is also falling. But what we've noticed in the last, year or so is that actually what's happened for the private banking system is that the number of reserves on private bank balance sheets has actually been increasing. And that's what people generally refer to as Fed net liquidity, meaning how many reserves are actually sort of floating around in the banking system. So it's weird, like QT is happening, but this green line, the number of reserves on the private banking system are actually increasing. And the main culprit for that is that one of the other sort of places where reserves can go, which is this gray line, the reverse repo program, that has rapidly drawn down. So those reserves obviously have gone somewhere. And one place that they've gone is into the private banking system. And so one of the real reasons why a lot of folks were sort of bullish in 2023 was that even though the Fed was, attempting to tighten by doing QT, liquidity in the private banking system is increasing. So on a balance sheet level, what this looks like is, again, we have our main players here. So we have the Fed, TGA, commercial banks, and money market funds. And so what reverse repo looks like is essentially you have a money market fund that, again, does not want deposits. It wants a safe asset that can generate risk-free returns, which in this case is 5% or whatever. And the way that shows up in the reverse repo is that if there's not enough T-bills or not enough treasury bills to satisfy that demand for the 5%, another facility that's available is the reverse repo program, where the Fed can essentially be the lender in this case that provides a T-bill like asset that offers that 5% annualized return, but it's not really a T-bill because the Fed doesn't create T-bills; it just creates these similar assets. So the money market fund will have a deposit at the commercial bank, and the commercial bank will say, these reserves, these are sitting at the reverse repo program, and then those returns get transferred to the money market fund. So what's happened here, and this is what I want to show is why it is that the reverse repo drew down and Fed net liquidity increased. What's happened is that when more bills enter the system, so there's this big thing that happened with Yellen, like deciding to issue a lot of bills rather than bonds, and a lot of people were sort of surprised by that. When the TGA issues a lot of bills, money market funds and other players who want cash-like returns have less of a need for the reverse repo because now the bills are actually present in the system. So I don't need to go through the reverse repo program. So when the TGA issued bills, what happened was, again, the commercial banks, the banking system was forced to buy those bills and transfer the reserves to the TGA. So now the money market fund says, I don't need the reverse repos returns per se. I can instead own bills as my safe, risk-free returning asset. And so in the interim step, reserves came out of the private sector and are now sitting on the TGA's balance sheet. So what that would look like is reserves on the bank's balance sheets are drawing down and reverse repo is drawing down. And then in the next step, the TGA spends those reserves back into the economy. And that's like a stimulus check or paying some sort of contractor or anything like that. So now those reserves are back on the commercial bank's balance sheets, but they're not sitting at the reverse repo because that was the first step. They're just sitting at the banks as any reserve balance would. So what's that showed up as is essentially the reserves at the reverse repo drawing down and showing up on commercial bank balance sheets. And that's why Fed net liquidity has been rising. So that's one additional sort of nuance on how the RRP fits into this whole framework.
And the deposits at the money market fund going up, is the net worth going up of the private sector in this scenario because because of basically deficit spending and a new asset liability pair when the Treasury decides to borrow money and spend it itself.
Right. That's yeah. So most likely the TJ is not giving a stimulus check to a literal money market fund. It's to a household or something, and then that household then wants to save through the money market fund. That's how the money market fund gets its deposits. So this net worth should actually be with the household, not with the money market fund. But let's say that the TGA in this case is literally giving a stimulus check to the money market fund. Then it would look like this.
Of course. And I meant that within that money market fund, there's two balance sheets. There's the household, the government contractor that then deposits that back into the money market fund. So go ahead.
Great. So that's Fed net liquidity and how the reverse repo plays into this. So now the next big piece of this is what it looks like for the Treasury to spend. So we just hinted a little bit at that. And so when the Treasury spends, and gets back to, what is money printing, what's not, I think the Treasury spending is the most, to me at least, clear example of money printing. And the reason is because when the Treasury spends, maybe it has to, issue securities in order to get the funds. All that may be true. But at the very least, the Treasury is literally printing new Treasury bills or Treasury bonds out of nothing and handing them to the private sector. And when the Treasury creates a stimulus check, hands it to somebody, that person becomes richer and now they can spend more. And that then tends to show up in CPI inflation. So that's, a pure example of what money printing looks like. And there's a lot of history on, how this Treasury spending would occur that I think gives some interesting insights. Because, in American history, there was a period when we didn't have a Fed, but the Treasury still spent. There was a period during the wars in the early 1900s when the Treasury would directly spend to the Fed, and that would be literal monetization. And then there was new laws placed where the Fed is now no longer allowed to do that direct purchases, and that's the current iteration we have today. So in the pre-Fed era, this is basically colonial times. I think this history is pretty interesting. The way that the Treasury would spend is simply the Treasury or the government would, print new pieces of paper, and there would be literal certificates. They'd be called Treasury bills, and they'd hand them to a household and say, you can pay this, you can use this to pay your taxes at the end of the fiscal period. And so if that's the case, if these pieces of paper serve as tax credits, then the household can essentially treat them as money. So, early on when the Treasury tried to do this, the private sector was kind of skeptical. They were like, but is this money? But very quickly, these bills started trading as if they were money. And so this is the literal most simple example of what Treasury spending looks like. And what I haven't included here is, when the Treasury issues bills, its net worth. So this should be a plus. The Treasury is increasing its reserve, its bill liabilities, and it's drawing down its net worth. So the Treasury is going more into debt. And then here, the household receives that bill. That bill is worth, $100 worth of my taxes. So now the household is becoming $100 richer, essentially. That was a process that occurred for, 100 years before the Fed. And it was a very, the essence of money printing.
And
Yeah.
I'll let you go in and fix that to a plus here. While I explain to people that there's one other step that really matters in which is that when the household gets that plus bills, okay, and the household is wondering, are these bills money? Which is what Ritik is saying. Are these bills money? A bank will say, yes, they are. Give me the bill. I'll hold them for you. I'll you a deposit, and then you can use that deposit to spend out in the private sector. So that's how the bill becomes money because the bank says, yes, I will take it as my asset and I'll issue a deposit liability to you. And then the next line item, you can bring that up now. This is 1914. The Fed is now is brand new, and the U.S. enters World War One.
Right. So here, the government wanted to essentially finance its war efforts. There was no law saying the Fed couldn't directly purchase these newly issued securities from the government. So that's exactly what the Fed did. It was seen as the sort of cleanest way to go about things. So here I've set it as two sort of separate transactions. The first thing is the Treasury General Account, the TGA, would create new securities out of nothing, and the Fed would immediately go and buy those and hand the TGA the reserves in its place. And then the second step would be the TGA would then spend those reserves into the economy, into the banking system, spending it on whatever military stuff was necessary for the war. So this is the true case of direct monetization, where the Fed was going to the Treasury and buying the debt directly. And this, I think, occurred in definitely the First World War and perhaps in the Second World War as well. And then there was legislation passed because this was seen as essentially, currency debasement, which it absolutely is. There was laws passed that prohibited the Fed from directly going and buying from the TGA. But the thing I want to emphasize is that all of these like legal codes as to how the Fed is allowed to participate or how the Treasury is allowed to participate, there's nothing is really changing in terms of like the essence of what is going on, which is still that when the Treasury creates money and issues it, when it creates a bill and issues it, it's still currency debasement. It's like whether or not the Fed is buying the security directly. If the supply of debt is rising, then the supply of money is still rising, and that means that everybody that had money in the past is now sort of getting poorer in terms of their sort of real net worth. So in the current era, the way this works, we mentioned this earlier, is that not through the Fed. So the Fed is not part of this transaction, but the primary dealers are sort of forced to buy the treasuries. And the way this works is this is what I would call a reserve drain, meaning that reserves were already present in the banking system. The TGA issues securities to then mop up those reserves and receive those reserves. The primary dealers are forced to buy the treasuries, and when I say forced to, I mean they're happy to, because the treasuries will typically have a higher yield than whatever they're paying for their financing. The primary dealer will finance that treasury purchase through a money market fund or through some other repo lender, and that's how the primary dealers get a hold of the treasury securities. And then now that the TGA has these reserves on hand, it can then choose to spend them into the economy.
And today, the yield on repo, meaning the financing cost, is higher than the yield on
Yes.
treasuries. That's what you get from an inverted yield curve. And from my perspective, even though it's punitive, the primary dealer is happy with the inventory because only with inventory can a business make money. And
Mm.
so I faced primary dealers when I was on the trading desk, and they're happy to take bonds because they can hedge out the purchase from you and sell him and then unwind the hedge and lock in a bid ask spread, and in that way the primary dealer is able to make money. So that's a small nuance there.
Right. That makes sense. So like I said, the last example here is a classic reserve drain. Reserves were in the system. The TGA gets those reserves by issuing securities in their place. So the question that this begs is, what if there were no reserves already present? So, I mean, here, there has to have already been reserves in the banking system for the TGA to absorb by issuing securities. But what if there were no treasury? What if there were no reserves in the banking system? How would this work? And that's when I think this expanded perspective that includes the Fed starts to be really useful, because the only possible answer to that question of how does anybody buy the treasuries if there's no reserves already present is that the Fed will come in as that lender of last resort and credit whoever the primary dealers are with the necessary reserves. Will credit the banks that the primary dealers bank at with the reserves to buy those treasuries. So we can walk through, and this is multi-step process, but I think it's just interesting to see how this takes place. So the first thing, in this world, there's no reserves in the private sector's hands yet. So the Treasury general account will have to first allow the reserves to be created. The Fed will have to create those reserves, and then those reserves can move into the Treasury general account. So the way this works is the first thing is reserves have to enter the system. The Fed will enter through a standing repo facility or through sort of like a discount window loan, enter a repo transaction with a primary dealer. The primary dealer will receive deposits that it can buy the treasuries from. It now owes that loan to the Fed, and the Fed will credit the reserves at the corresponding commercial bank. So here, the reserves are now present. So what's happened is, before the actual securities have gotten purchased, these treasury securities, new reserves had to have been created because, like we said, reserves have to be present for the TGA to mop them up. Warren Mosler the way he likes to put this is, you can't have a reserve drain without a reserve add first. The reserves had to be there. So now the reserves are there, which means that there is enough liquidity to buy the securities. So the next step is the Treasury auction. The TGA will print bonds. It'll create new treasury securities out of nothing. The primary dealers will take down those bonds. They'll buy them with the deposits that they had, and the commercial banking system will move those reserves into the TGA. So that's what this looks like. So now the TGA is like locked and loaded. It has the necessary reserves to spend into the economy. So the next step is the Treasury general account spends those reserves on whatever the government spending program was. So if you hand a stimulus check to the households, the Treasury general account owes these treasury securities, but now it's going to get rid of the reserve assets. So it's going to necessarily draw down its net worth. It's going to go further into debt. It hands the reserves to the household's commercial bank, and then the commercial bank deposits that household with that deposit. And now that drawdown in net worth by the TGA shows up as net worth for households. So this is why I think treasury spending is just a pure form of money printing, and it's because somebody is receiving new wealth that they can essentially spend into the real economy. So now that spending has occurred, the Fed can close the repo transaction with the dealer because the dealer no longer needs that financing. So the way that this looks is the Fed gets rid of that primary dealer loan, repo loan, extinguishes the reserves that it had handed the commercial bank in the meantime, and the primary dealer no longer needs the deposits because it owns the U.S. treasuries. And then lastly, the primary dealer can sell those treasuries to the commercial bank. So what's happened here is, once the Fed has gotten rid of the loan, it's less so that the reserves on the commercial bank are what's backing up the deposits on the household side. So if we go back to this step, it's like the commercial bank has reserves that match the deposits that the households they own. When the transaction gets closed by the Fed and the reserves get extinguished, it's like an asset swap where instead of reserves, now the commercial banks are holding treasury securities. And it doesn't necessarily need to happen this way. I'm just showing this as an example. But through all of these steps, what's clear is that the reserves were sort of used as an interim step based on our current version of the legal code and how these players are allowed to transact with each other. The reserves are used to make sure that everything kind of goes smoothly. But at the end of the day, the Treasury general account has created U.S. treasuries out of nothing. The treasuries are then handed to the commercial banks, and then the commercial banks are happy to deposit, at whoever receives the stimulus check or the government spending. because the commercial bank in this case will be earning a decent yield on the treasury securities and will most likely be paying nothing in the deposits.
Yes, so a couple things to note here. Number one, this is slightly different than the way that you presented it last time, which is that the Treasury spends first. This is showing that reserves do technically have to be present. So that's an important thing to note, because that mentally makes more sense to me than the other way, even though in theory you can argue the other side. So reserves have to be present first. But then second, it goes back to what we said at the beginning. Reserves are simply an assistant in allowing the money to flow through the system, but technically are not needed other than to get money into the TGA, because that's how the TGA, it's the only way the TGA can receive money. The only way the Treasury can receive money is from a reserve balance in the system. But in the end, as long as the Treasury security exists, you don't need the reserve anymore. You need the reserve to allow net Treasury securities to come into the system, to come into existence.
Right. So on the issue of so in the last episode, I made the claim that the government can essentially spend money into existence, and so again, basically the differences come in a sort of like a sort of semantic sense and sort of like a technical legal code sense, where yes, the Fed can't like spend new reserves into existence. The only way that the Fed can raise its reserve liabilities is by buying assets at the same time. It has to do a matched asset liability. And the Treasury general account is where the reserves come out of into the private sector's holdings. So in that sense, the reserves can't literally be spent into the private sector. But if the law was suddenly changed back to the colonial days, essentially what's happening is new money is being printed. Perhaps it's not reserves, perhaps it's treasury bills, it's treasury bonds, but those are also money-like assets, and the Treasury General Account absolutely is printing new treasuries into existence. And then the other point is on the question of reserve drain, reserve add. The reserves have to have been present first. So without this first step of the Fed providing reserves to the primary dealers, the TGA would have nowhere to get the reserves from to spend. So I think there is a bit of a semantic point that's valuable to still sort of see Treasury spending as first creating the money and then the issuance mopping up that money and handing you Treasury securities in return.
Yes, and our goal today is to provide you the objective side, which are the T charts, and then provide a little bit of our own subjective takes on what we are looking at. So go ahead and continue on with QE and 2020.
Great. So this is the last sort of application point, which is on the issue of was there monetization in 2020? So the really interesting thing to me here, because I think this actually does is pretty instructive on what the role of the Fed is and how necessary the Fed was, is that the stimulus checks, the CARES Act in 2020, the PPP loans, all of that was actually financed entirely with bills. So in this first step where the government spent money, the government created bills, the bills ended up on the banking system, the bank bought them in droves, and the Treasury General Account drew down its net worth and handed that net worth to the households in the form of stimulus checks. That was all bills because essentially, obviously it's a global panic. There was a huge rush into the most safe and liquid assets possible. Those are treasury bills that have essentially no price volatility because they're short-term assets. So the entirety of the CARES Act, almost $5 trillion of spending, at least 2 or 3 trillion of that immediately in a month's time was financed through bills. And the Fed was really not a part of that because as the second line shows, the Fed's QE, which did take place simultaneously, was a QE of bonds. The Fed was smart enough to say, we're not going to compete with the private sector that obviously has a huge demand for these bills. We're going to do our QE of bonds. And like we've showed in previous slides, that's what this looks like. And then we get to all the semantic points of, okay, but if this huge trillions of reserves didn't end up in the bank system, would the private sector be as excited to buy all these bills because it has bonds to compete with those bills. So there is still a little bit of a question of, is the QE that's taking place assisting the issuance of the stimulus checks? I tend to err on the side of no. The stimulus checks, there was sufficient demand because bills were being created and people were happy to buy those bills. But the other question is, okay, yes, obviously in COVID, people want safe assets, so they're going to, flood towards the bills. If today the Treasury General Account tried to issue $2 trillion in bills, are there enough immediate buyers? That's another question. We don't really know the history. So because we don't have the full historical perspective of each of these variables being controlled and then manipulated, we can't do that experiment. We can't really know how relevant or how important the Fed is. But on a mechanical, very technical level, I wouldn't consider what happened in 2020 monetization by the Fed, because the Fed wasn't literally buying those bills. The Fed was doing its own thing. But there is an argument that it was indirect monetization because the Fed was at the same time purchasing tons of assets and getting those off of the private sector balance sheet.
Presenting both sides of the argument for every single T-chart that we've laid out here. Ritik, Goyal, thank you so much for this incredible overview and masterclass in monetary operations. We sincerely believe that the viewer will be able to take today's episode with a notebook, go and rewatch it, and come out on the other side informed on how money comes into existence, the difference between the Fed, the Treasury, the banking system, primary dealers, and money market funds, and how they all interact with each other, and hopefully use that information to continue on with the Bitcoin layer. Find us at thebitcoinlayer.com/subscribe for our free research publication. And of course, subscribe to this channel. Ritik, please tell people where they can find your work online.
Yeah, you can follow me on Twitter at RPGOYAL_. And then I also write at the Monetary Frontier Substack. Yeah.
Great. And we'll catch you guys next time here at the Bitcoin Layer.
Thanks.
Special thanks to River for sponsoring this channel. Purchase Bitcoin without any fees when you use River's DCA feature. River has become our trusted source of accessing the Bitcoin market because they don't use any third-party custodians. This is a very, very important thing to understand. River is not using another company to store the Bitcoin for them. They have their own multi-signature solutions, which means that they have designed their own way to make sure nobody else has responsibility for the Bitcoin for the time that you have River hold your Bitcoin for you on their platform once you have purchased it. So go check out river.com today. Thanks for sticking with us. As always, at the Bitcoin Layer, subscribe to our channel. Subscribe to our Substack at thebitcoinlayer.substack.com so that you can follow along our latest research and analysis.